All right, let's get right into it. We are going to tackle one of the biggest, most repeated money myths out there. Seriously, it's a piece of financial advice so common that it has almost certainly shaped how you think about your future. You know the one. You've heard it a million times, right? From your parents, your friends, all over the internet. It's treated like this unquestionable financial gospel. The whole idea is that every single rent check you write just vanishes into thin air, while a mortgage payment, well, that's an investment. But is it really? I mean, is that the whole story? Or is this belief, this thing that's been drilled into us, actually keeping us from seeing a smarter, maybe even more flexible way to build wealth? Let's peel back the layers here and see what the numbers actually say. Okay, so first things first, let's talk about the pressure to own a home. Because honestly, before we can even begin to look at the math, we have to acknowledge the powerful cultural and family forces that are pushing us in this direction. I mean, for generations, owning a home has been sold to us as the ultimate sign that you've made it, you know? It's seen as the key indicator that you're stable, you're successful, you're a real adult who's making actual financial progress. And look, this isn't just some feeling you have. The message comes at you from all sides. It's constantly reinforced by people who genuinely think they're giving you good advice, and, let's be real, by entire industries that have a very good reason to want you to take on a massive mortgage. So yeah, the sales pitch for owning a home is loud and clear. We all hear it. But what about the fine print? What's the part of the story we're not being told? It's time to move past that emotional pull and really look at the financial realities that, well, often get swept under the rug. This is so important to understand. A house isn't just an asset. It's also a huge liability. And what I mean by that is all the unglamorous ongoing costs of owning it that do not build your equity, your actual ownership stake. We're talking property taxes, insurance, all the maintenance, those fun surprise repairs, HOA fees, and of course, massive interest payments. That is the true price of that asset. And trust me, it adds up incredibly fast. So, this brings us to a really important pivot point. It's time to redefine what rent actually is and uncover the real financial picture behind all of this. So instead of thinking of rent as just throwing money away, let's try a reframe. What if rent is simply the price you pay for a service? That service is shelter, but it's shelter without the huge financial risks, the responsibilities, and the immobility of ownership. You're essentially buying flexibility. And in today's world, flexibility is an incredibly valuable asset. And you can see the core trade-off pretty clearly when you put them side by side. Renting, it gives you predictability and freedom. Your costs are fixed. Owning, that involves a lot of variable costs and a really deep commitment. The key here isn't that one is good and the other is bad. That's not the point. They are just two totally different financial strategies, and they come with completely different risks and rewards. Okay. And this brings us to the absolute heart of this whole argument, a concept called opportunity cost. It's a big one. Basically, every financial decision you make isn't just about what you get, it's about what you have to give up. So when you tie up a massive chunk of money in a down payment, and then you're paying all those ongoing home expenses, the real question is, what are you not doing with all that money? Let's make this super real with an example. Imagine the total monthly cost to own a home. We're talking the mortgage, taxes, insurance, a little set aside for maintenance, comes out to, say, $3,000. But you could rent a very similar place for $1,800. That difference is $1,200 every single month. That isn't just money saved. That's capital that you can now put to work. That $1,200 difference, that's the opportunity cost we were just talking about. Instead of all that cash getting eaten up by housing costs, it can be invested, put into assets that have the potential to grow and compound way faster than the equity in a house typically does, especially in those first several years. Okay, so that's the theory. But how does the math actually work? Talk is cheap, right? So let's really dive into the numbers and see how a strategic renter could potentially come out way ahead. And here's the part that honestly, most people just don't realize. When you look at your mortgage payment in the early years, it's basically split into two buckets. There's principal, that's the part that actually pays down your loan and builds your ownership, and then there's interest. That's just the fee you're paying the bank. And in the first, say, 5 to 10 years, that interest slice of the pie is massive. You're building almost no equity because most of your money is just going straight to the bank. So what you really have is a race between two different wealth-building engines. On one side, you've got your home equity, which is just inching forward, barely moving at first, And on the other side, you have that money you could be investing, which has the potential to compound and grow at a much, much higher rate. It's literally a slow crawl versus a potential sprint. And in those critical early years, the market often gets a huge head start. Now, let me be super clear about something. This does not mean buying a house is always a bad decision. Not at all. It can be an incredibly powerful way to build wealth, if the circumstances are right. The key is it has to be a strategic move, not an emotional one. You really need to plan on staying put for a long time, like 7 to 10 years minimum, to make up for all those high upfront costs. And it absolutely has to fit comfortably within your big picture financial plan. So, okay, how do you actually apply all this to your own life? Well, here's a new way to think about it. A new framework for making your housing decision, one that's free from all that outside pressure. It really boils down to 4 key steps. Number 1, and this is the absolute most important rule, invest the difference. If renting is cheaper for you, you have to be disciplined about investing that savings every single month. That's the only way this whole strategy works. Okay, number 2, build mobility capital. Recognize that your flexibility is a huge asset. Being able to move for a better job could boost your income way more than a few percentage points of home appreciation ever will. Number 3, buy for your plan, not for your ego. Homeownership should be a tool that helps you reach your goals, not just some status symbol you're stretching to afford. And finally, number 4, run the numbers. I love this phrase, emotion is expensive, but math is calm. Sit down and actually compare the total cost of ownership versus the cost of renting, plus investing what you save. A simple spreadsheet can give you all the clarity you need. Because at the end of the day, true wealth is built by making informed decisions, not by blindly following tradition. Renting isn't throwing money away. It can be a very, very strategic financial move that lets you build wealth faster and with way more flexibility. You want to know what the real waste is? It's making one of the biggest financial decisions of your entire life based on an outdated myth instead of doing your own math. So the question I want to leave you with isn't just should I rent or buy? It's which path, right now, is the smarter one for your financial future.